So welcome to THOR VIP class number 1, you guys. In this lecture, I'm going to introduce all of you to PD arrays, ICT PD arrays, which I'm sure mostly you all are familiar with the PD arrays, generally speaking. Throughout this class, in the first place, I'll introduce a couple PD arrays, explain what they are exactly and how we use them. And then later on, I'll show some advanced usage of these PD arrays. Let's begin. So, what is ICT PD array, first of all? So the ICT PD arrays essentially stands for premium discount arrays, right? And we use the PD arrays as a guide to determine liquidity in the marketplace. The reason being the importance of PD arrays is basically determining the liquidity, right? Because market is moving liquidity to liquidity, or from imbalance to, or from an inefficiency to another liquidity level, right? By using PD arrays, we can also determine the bias and the narrative in the marketplace. I underline the narrative because if you don't know the narrative, what's the point of knowing the bias, right? It's untradeable. It becomes untradeable, especially if you're day trading. ICTPD arrays is our roadmap as a traders in the marketplace. You can think of this as if you were a tourist you know, in a country that you've never been before. You don't know the language, right? You got to get to another location. Maybe you want to grab a cup of coffee or something, but you don't know how to get there, right? And you don't have, imagine you don't have access to internet, you don't have Apple Maps and all that, right? How are you going to get there, right? If you don't know the language. You can think ICTPD arrays as your map in an unknown country, basically. It'll help you to get from location A to location B. That's why PD arrays are the single most important element in ICT concepts, which is why I'm covering this in the lecture, in the class number 1. Basics first, right? So we have a couple PD arrays, premium and discount arrays, and what we'll see in the marketplace is when we have an expansion leg, we'll always have a premium zone, premium array, and then we'll have discount array, right? And the upper portion of this expansion leg from the buy side to all the way down to the sell side, the upper portion will be our premium array, and the lower portion will be the discount array. Discount zone, rather. So in the premium array, in the premium zone, you'll have old highs, rejection blocks, order blocks, breaker blocks, fair value gaps, volume imbalances, mitigation blocks, and propulsion blocks rather. And on discount, it'll be all inverted basically. You'll see old lows, rejection blocks, order blocks, breaker blocks, fair value gaps again, volume imbalances, mitigation blocks, and propulsion blocks. And you'll be using these PD arrays to determine the bias and the narrative and what the market is doing, right? And at the end of the day, you'll be using these PD arrays to find entry points, entry levels when you're trading. So let's start with old highs and old lows. The reason I want to cover old highs and lows in the first place is because highs and lows these points are providing the liquidity to the marketplace, right? They are also forming the market structure itself. But to understand what old highs and lows is, we don't look at every high and every low, right? We'll be looking at swing levels, swing points. And swing points is essentially requires a 3-candle formation. For swing highs, we're going to have 3 candles, 3-candle formation, right? And in the middle candle must be higher than the candle to the left of it and the right of it, right? That creates the swing high. And swing low, on the other hand, it's going to be the opposite. The middle candle must be the lowest candle, lower than the left hand side of it and the right hand side of it. And if you are not familiar with swing points, I recommend studying this in the first place, and train your eyes to spot these levels, right? If you're having a problem spotting swing levels, you can also use indicators. You can put it on TradingView and it will show you the swing highs and swing lows, all of that automatically. So you don't have to deal with, marking out every high and low. These levels will be referred as buy side liquidity on the swing high, and on the south side of the curve, it'll be called sell side liquidity. Uh-oh. So this is an example for both sides. On the left hand side, it's the buy side. If you look at this candle right here, this candle is higher than the candle to the left of it and the right of it. So this high is our swing high. Same deal here at this high. It is higher than the candles right next to it, three candle formation. This is another swing high level. So these levels are buy side liquidity. On the right hand side, you'll see sell side. Same deal, the opposite. If you look at this candle right there, it is lower than the candle left of it and the right of it, creating a swing low. Same deal here. The candle is lower than the candle left of it and the right of it, swing low, sell side liquidity. By the way, guys, before I move on, I forgot to mention, if you have questions or anything, just write them down for a second. I'll get questions when I'm done with this presentation. I don't want to, go back and forth with the questions, answers, and stuff like that. Perfect, beautiful. Second PD array is order blocks. Order blocks is essentially the highest level or the lowest candle with an up close or a down close candle that has the biggest range between its open and close near a liquidity level, right? If it's not a near liquidity level, basically it's not a significant, it doesn't have any significance to it, right? And the most important aspect of this PD array is the mid level, which is called mean threshold. So if you pull up your Fibonacci tool and measure the 0.5 or 50% of this candle, that level is called mean threshold. And the open price of this order block, of any order block actually, is most important two levels, right? You would expect the biggest reactions, or you should see biggest reactions from these two levels. Also, for the order block validations, once the following candle moves away from an order block, then and only then it confirms it. Meaning, if you look at this this picture right here, what you'll see is we have two down close candles, right? And the third candle breaks away to the upside of it and closes above or violates the last down close candle's high, right? When you get that, that is your confirmation for an order block. And later on, you can use it. I'll show how to execute on order blocks. So, bullish example for an order block is basically you would want to see a liquidity purge first. In this case, we have a sell side here, right? This is a swing low, and this gets attacked first. Then this candle right there closes as a down close candle, and the very next candle to it just rallies, breaks away from the last down close candle, right? Once this candle closes up, this up close candle closes and breaks away from the previous down close candle, now you have an order block here. This order block is now confirmed. You can look for, potential long entries utilizing this order block. When it comes to order blocks, I would like I said, you'll see the sensitive areas are just the open price of this candle, order block candle, or the mid level, mean threshold of the order block. So you can use those two levels to seek long entries, long positions. On the bearish side, it will be upside down. You'll have to see a liquidity level getting raided, right? Once the market completes the raid, in this case, it breaks away to the downside from that level energetically, right? This red candle, this black candle, moves away from the last up close candle, forming a bearish order block here, confirming that. And once it's confirmed, now you can use this up close candle as your bearish order block. Again, you should be looking at the open level, close level, and the mean threshold, which is 0.5, 50% of this candle. Third PD array, we have breaker blocks. As you might know, I love using breaker blocks. It's because breaker blocks are essentially the failed order blocks after a purge on liquidity, and they're highly reliable and usually gives instant feedback, which is why I love to use breaker blocks. I probably prefer breaker blocks over order blocks, honestly. So in this case, what you have when it comes to breaker blocks is basically you've got to wait for swing form formation, right, on the bear side, and then that swing low causes a higher high. So what you'll have is you're going to have a low, high, then a lower low, and that lower low changes the sentiment of the marketplace and makes a higher high, which gives a breaker block, right? And then it breaks down. This is an order block. It was an order block. Now it's failed order block, turns into a bearish breaker block, right? On the bullish side, what you're going to have is you're going to have a low, high, then a lower low. That lower low making it changes the sentiment, makes a higher high, violates this bearish order block, which now becomes a bearish. Bearish order block, which now becomes a bullish breaker block. Right now, when price returns back to that level, you should expect some sort of like reaction from it to expand higher for a continuation higher. These levels are breaker blocks are essentially like the first indication in the marketplace when there is a reversal happening. So smart money reversals will always contain breaker blocks. Same thing with manipulations, which is why it's highly important. So as an example for bearish breaker blocks, so in theory, breaker blocks are basically utilized when the buyers that buy at the swing low, meaning here, swing low, here, swing high in this case. So people are getting short here, market makers getting short here, right? Then it moves in their favor, but immediately after this liquidity purge, it reverses. Right now, the short sellers at this high, they're trapped, right? What they'll do is they will use the breaker block to mitigate their losses, right? They're looking for a fair price in the marketplace to cover their losses. What that means is if they're short here, they don't take partials or they don't close their positions. They wait for market to displace lower. It doesn't happen. Market displaces higher instead. Now they're trapped. They're waiting for price to touch back into the breaker block, which is a fair price for them to mitigate their losses, right? Essentially, this setup is a long entry for us, for ICT traders, right? When they're mitigating their losses, we are entering long positions using that liquidity to expand higher. And on the upside of the things, there's an example. Let me just show an example first. So what we have here is basically we have a low here, high, low, high. Then that higher high creates or makes a lower low, right? When that happens, that means sentiment in the marketplace has changed. Now we are on the south side of the curve, and the reversal pattern is going on here. Because of that, we have a breaker block, right? If this was to continue higher, this breaker block area, these 3 down close candles, was supposed to be order block and was supposed to hold the price above it. It failed to do so. Now this failed order block became a bearish breaker block, right? When price comes back to it, that's our short signal. Now we can enter short sell and target the south side. About the breaker block theory, I can show it here. It'll be cleaner, I think. So what happens is market makers who wants to long the market up here uses these 3 down close candles, right? Once it moves like that from that level, they go long here, right? Using this order block, they go long here, and price collapses, right? Once that happens, they're trapped in their long positions, and they're actively seeking a fair price to mitigate their losses. So they're not closing their position up there, right? They're waiting for price to come up into the break block. Once it does that, that's a fair price for them to exit their long positions. In a bullish example, same deal, upside, everything is upside down. We have a low, then a high. That high causes lower low. This lower low creates a higher high, right? So it violates the bearish breaker here, bearish order block here. Once that happens, failed order block becomes a bullish breaker block, and now that is a long signal for us. We can utilize that breaker block to go long in the marketplace. Now, in theory, again, the same thing. The market makers who are going short in this price action here, using this order block, or maybe impulsively short selling what was it, like this expansion, this displacement, now getting trapped with this move in their positions, right? And they're actively now seeking to mitigate their losses, and they're going to be using this bullish breaker block to collapse their trades to their long positions. And that is our trigger for long entries. The next PD array is called rejection blocks. Now, rejection blocks are a bit tricky. First of all, let me explain what a rejection block is. So a rejection block is when price forms a high or a low with wicks while purging a liquidity level, and immediately engulfs the purge with the following candle, right? That means we are in a reversal market. Price comes back into a liquidity level, rejects it, and the following candle expands higher, right? Once this happens, the chances of having a rejection block in this area is very likely. The rejection blocks are usually the equal levels. So in the price rejection, market algorithm prints equal bodies, as you can see here. This candle engulfs the purge candle, right? Once it engulfs it, that is your confirmation. And when you see these bodies equally printed by the algorithm, that becomes your rejection block. Now, once that happens, you can expect price coming down into that level, right? And that is your entry signal, entry trigger for long positions in this case. And you can expect rather a run on buy side levels. And rejection blocks usually are the main cause of SMT divergences between assets, right? When you'll see, I'll cover SMT divergence later on, but for this context, what you're going to see is you have a swing level here, swing low, another swing low here. Well, what you'll see is you'll see this printing a higher low, whereas another asset will be purging this last sell side level, and that'll create an SMT divergence, which is a great confluence for you to go long or for you to utilize rejection block, right? And the same thing like breakers, when a rejection block is present in the marketplace and price is reacting to it, that is the first indication, first sign of a smart money reversal. These are reversal, quote unquote, patterns, basically. And as an example, price rate purging the liquidity level on the buy side. This is a bearish example, bearish rejection block. Then immediately after the purge, it engulfs the purge candle, right? Immediately breaks away from it. And the open of those candles are the same level, which is the PD array itself, the rejection block. Now you can draw that in time and use that as a low risk sell entry. Now, one thing to mention about rejection blocks is whenever this kind of price action happens, what you'll usually see is you're not going to see a fair value gap or an order block at these highs over there. So when the SMT, not SMT, but like the reversal is happening, you're not going to have a fair value gap or an order block or a breaker block at the moment. What you'll have is a rejection block. That's why you got to be aware of that. Like in this case, you can see that you don't have a bearish fair value gap, you don't have an order block, right? What's happening is price coming back, pulling back into the rejection block and using that as a catalyst to go lower. And the bullish rejection block example is same deal, a liquidity purge on the sell side this time, purges that, comes back down one more time and immediately rejects that level, expands higher, right? Once this expansion is there, you look at the bodies. If they're at the same level, the open level, that is your rejection block, and now you can seek long entries, or you can anticipate a reversal at these levels. The next PD array is my favorite one. It is a fair value gap. So the fair value gaps is it is a range in a delivery where one side of the market is delivered inefficiently, right? You'll see this PD array in the expansion swings usually. And this kind of price action is caused by it causes imbalance in the marketplace. And because the market has to be efficient at all times, price tends to be drawn into these inefficiencies, which we call fair value gaps, or yeah, fair value gaps basically, or FVGs. The fair value gap formation is also three candle formation. So what you're gonna have is you're gonna see three candles printing next to each other, and in the middle of the middle candle will not have any wicks or anything, and the following candles also are not going to be overlapping the middle candle. So what we're gonna have is the first candle's low, from the first candle's low to the third candle's high is just delivered. In this case, it delivered just the sell side of the market. Right now this area is inefficiently delivered, or it's imbalance. There is an imbalance in the marketplace, and the market will more likely to come back up here to balance the market, and this will be a catalyst to go short or for a sell-off in the marketplace essentially. As a bearish example, there is an expansion swing from this high to this low, and in that that expansion, we have an imbalance here, a bearish fair value gap, or a CB. The CB is what that means is basically the south side of the curve was delivered inefficiently. So here, buyers were lacking in the marketplace, right? And because of that, there's an inefficiency here that is imbalanced. So what will happen is market will come back up here to deliver buy side, and that'll be our catalyst to go short in the marketplace, right? It uses that as a catalyst and comes back up, then rallies or price continues lower here. On the bullish side of the things, same deal. Price moves higher, creates an inefficiency here. Now, what happens here is market was delivered one-sided, right? The south side was not delivered here, which is basically an imbalance, an inefficiency, an efficiently delivered price here. So what will happen is market comes back down here to make marketplace efficient, and that pullback will be our trigger to go long positions, take long positions. Now, here's the real deal, guys. From now on, this presentation will be more advanced. I'll show you how you use ICT PD arrays in more advanced way, which is how I personally use it as well. If you're not familiar with all of these, advanced usage of ICT PD arrays, I would recommend you taking notes and then backtesting it. And then once you complete your back tests, do forward testing before putting any actual, putting money on the line. Let's dive in. This is fun stuff. Okay, so the first things first, advanced usage of order blocks. When it comes to order blocks with an extensive understanding, so you got to have an extensive understanding of a market maker model deliveries to be able to use order blocks, or rather advanced usage of order blocks, right? What will happen is on one side of the curve, when market is expanding higher, for example, okay, order blocks are used to accumulate long positions. But when the sentiment changes in the marketplace, right, when we go from buy side of the curve to sell side of the curve, the same accumulation price range, which is order block, is now being used to accumulate short positions, right? What you'll see is this order block here is being used for long positions on the buy side, right? Now we have a sentiment change here. We're going lower, right? Maybe there's a reversal here, right? Now we have a market maker sell model, and on that side of the curve, the same order block will turn basically another supported resistance level. It'll be reused on the south side of the curve. Now this comes handy when you don't have a fair value gap in this expansion leg or any kind of significant PD arrays in this expansion leg. That's when this stuff comes handy, right? What you gotta be able to you gotta have an extensive understanding of market maker models to be able to do this. Now as an example, if you look at this level here, we're expanding lower, meaning south side of the curve. Order flow is bearish here, right? We have an order block here. That order block was used, bearish order block used one more time to seek sell side. And then with this expansion, this displacement, now the sentiment has changed, right? There is a market structure shift there. Now we are on the buy side of the curve, right? What you'll see in the price is when the sentiment has changed, the same bearish order block, now it's going to be used or reused rather for as a support essentially in the buy side of the curve. Now you can see that here I drew it in time, that same order block, and you can see how price is reacting to that level, and there are no fair value gaps or any significant PD arrays in that swing level, expansion level right there. No fair value gaps, no breaker block there. It is being reused and expanding higher. And on the upside, on the downside rather, we have a bullish order flow. We're expanding higher to seek liquidity, and then market sentiment has changed, right? On the buy side of the curve, we have an order block right there. It's being used to go long. Once the market completes its objective, we got its reversal, it breaks lower and lower, right? And then the same level, the same order block, now on the south side of the curve, will be reused for short positions essentially. So it's gonna react to that same level for the downside now. And if you look at this candle right there, this down close candle, initially when it opened, when this candle opened, it goes higher a little bit. This is the manipulation into this order block, or like failed order block now, to go lower, right? And because there's no fair value gap whatsoever in this area, you can utilize this old order block to find entries or to understand the narrative in the marketplace. Advanced usage of break blocks. This is what I like to use the most. So when it comes to break blocks, the traditional way to do it is we look at the open, high, low, and close of the breaker block, right? We take it from all the way to the low of the breaker block to the high to high of it, right? We extend that area in time, and we seek long positions in this case. But what I like to do is basically, because I like precision. Oh my god, and immediate feedback. I like to look at the wick of breaker blocks, right? So instead of looking at the full range, the reason is market algorithm will refer to this specific level, the wick, and making that range more sensitive, right? So if you're correct with the draw on liquidity, what you're gonna see is you're gonna see the bodies when it returns back to that breaker block, the bodies were respecting the breaker block's wick, right? This is more precise than using the whole candle itself, right? And it is also a signature. It's a sign whether you're right or wrong, because when it's pulling back into a breaker block, if you see the bodies of the candles are not respecting to the wick, that means you might be wrong, right? That is an immediate feedback. So you might want to close your close your long positions, or whatever the case is, maybe tighten your stop loss and stuff like that, right? And this usually happens due to big money buying at the lows or highs, which then causes the impulse forming swing low, high, and a breaker block, right? And like I said, benefit of doing this is getting an immediate feedback, which is why I love to use this, because I know immediately if I'm right or wrong. Now, one thing here, sometimes what happens is you might not get a reaction, or let me put it this way. Sometimes you'll see bodies are not respecting to the wick of the breaker block. Sometimes you'll see body candle close outside of it, and then later it still expands, right? That can happen. But there's a general rule of thumb for that. If you have a BPR, which I'll be covering that as well later on, if you have a balanced price range below the wick of a breaker block, the chances of a breaker block wick holding is now lower probability. So you can expect price to go lower than that and violating the wick of a breaker block when you have a balanced price range present above or below a breaker block. So as an example, we have a reversal here, reversal pattern, typical. We have a low, a high, a lower low, and this lower low causes an energetic move to the upside. Now we have a higher high, right? Lower low to higher high creates a breaker block. Now, if you want to be more precise with your, entries and stuff like that, you look at the wick of a breaker block, extend that in time, and that level, specifically that level, has to be sensitive, and you do not want to see candle bodies when it's pulling back into that level. You don't want to see candle bodies closing outside of that level. And in this case, you don't see that. It is trading below, wicking lower, right? Wicks do the damage, that's fine, but essentially it closes above the breaker block. Now it could close within it, that's totally fine, but it shouldn't close below, right? And one thing here, there's no BPR in this price range. Because of that, you can safely use or utilize this breaker block here. On the bearish side, same deal. You have a low, actually high, low, higher high, and that higher high causes a lower low. Now the sentiment has changed. We have a reversal here. When there's a reversal, you'll always have a breaker block, right? And the breaker block is this old order block, right? You extend the wick of the break block in time, and that level should be sensitive and should be respected with the bodies. Wicks are totally fine and permissible. You can utilize that level to go short and target the sell side. The reason I like to use this method is basically whenever you don't have another PD area at this reversal area. In this case, you don't have a fair value gap. That's how you can utilize this. Breaker block wick comes up. Now you can go short. If price was to, violate it with the bodies and close above its wick here at the annotated level, now that means because you don't have a BPR in this range, that means the chances now it's against you. Market might be against you, so you might be cautious with your stop loss. Maybe you want to tighten it or collapse the trade. I like to collapse it when I see that happening. That's happening. This is a beautiful signature for me, and it's telling me, giving me immediate feedback, right, that I'm on side with the market, and the draw on liquidity, whatever the case is that I outlined and I anticipated, is correct. I'm on side with the market, right? That's what it indicates. Now, advanced usage of fair value gaps. So the fair value gaps, when it comes to fair value gaps, all of them actually has a meaning behind it, right? And mostly we don't know what it means. And I'll show you what it actually means. To be able to use fair value gaps, more advanced manner, First things first, you gotta have multiple fair value gaps in the price leg, in the expansion leg, right? You gotta have two or more fair value gaps. But what is the meaning of multiple imbalances or multiple fair value gaps? So that tells us that one of these fair value gaps will be used for accumulating positions, whether it is accumulating short positions or long positions, and the other imbalance or imbalances will be used for institutional order flow entry drills, or shortly IOFED. Now, what is an IOFED? IOFED is when price wicks into a fair value gap, but body closes outside of it. So it basically gives immediate reaction and close above it and keeps in the direction of the draw on liquidity, right? But how do we use that information? It's basically when there are multiple imbalances, fair value gaps in the expansion leg, you could accumulate positions with the smart money in one fair value gap, right? Scale into a position. Then later on, you can add more to your starter position with the manipulation, meaning IOFED. Now, on the relative time frame, whenever you have a multiple imbalance on that relative time frame, you're not going to be able to see the manipulation lower, right? But if you were to shift down into another lower time frame, you'll see it clearly. Like you'll see the clean point power of three, so to speak. So you'll see a manipulate consolidation, manipulation, then expansion. You'll see that on the lower time frame. As an example, so we have a purge on liquidity here, then immediately price reacts to that level, right? Expands higher energetically, creating two fair value gaps here, right? Now, whenever you have multiple fair value gaps, this is what it's telling you. This is the story behind it. So in this case, since this is a bullish example, the upper fair value gap will be used as an accumulation zone, meaning market maker or smart money will use this area to accumulate long positions, right? And the lower fair value gap is going to be the manipulation, meaning it's going to wick down into there to later on expand higher, right? Knowing this information, like I mentioned earlier, how I like to use this information is basically whenever I see this as price action, I like to go into a long position with a starter position, let's say like long this wick because it's tapping into the fair value gap accumulation zone. I like to scale in to a long position and I wait a little more. Maybe at the CE of this fair value gap, the mid level of this fair value gap, I add one more. And I like to put a limit order in this IOFD, the lower fair value gap. So I accumulate three contracts essentially before it moves higher in my direction, right? And this accumulation here, this consolidation rather, or this range, does not bother me at all because I know that this is actually even better. The longer this accumulation takes, the stronger the higher move will be, right? Knowing that information, whenever I see this price range going back and forth, I don't get to be concerned about it, right? So this is a very powerful tool in my opinion. Same deal here, multiple fair value gaps, multiple imbalances. The upper one, again, this is a bullish example. The upper one will be used as an accumulation. The lower one will be used as a manipulation. You can do the same deal when it comes to execution. You can execute on this one, and then you can, enter more on the lower one, or you can just basically wait for the lower one to enter. But sometimes you might miss some entries if you do so. Just be mindful of that. Um, and about the manipulation. So let's say this is a 15-minute time frame, right? When you're seeing a 15-minute multiple fair value gaps. If you were to look at this price action on a lower time frame, because time is fractal, what you'll see 1 minute candles printing, in a range bound. Then these wicks below will be the manipulation leg lower, and then it rallies higher, it expands higher, and that price action on the lower time frames, you'll have a breaker block, for example, or you'll have a balanced price range, for example. You'll have the smart money reversal patterns, so to speak. same deal. Couple fair value gaps, multiple imbalances. Upper imbalance is being used as an accumulation. Price spending time there, and the more time it passes in this accumulation area, the better. That means there's more liquidity for the upside, and then it manipulates here one more time, comes back down, and rallies after. Bearish example, same thing, everything is flipped. We expand lower, creating multiple imbalances on this leg, two fair value gaps. The lower fair value gap in this case, because it's bearish, will be used as an accumulation, and the higher will be used as a manipulation, or IOFED, which is right there. It wicks into it, body close outside, then it goes lower. One thing about IOFED is if it doesn't IOFED here, if it body closes within, that usually indicates you can still be on side with the market, but that usually indicates weakness in the direction, in the move, right? That means, in this case, in the short sell, it might mean the bearish move or the bearish order flow is weaker than I would like to see, right? That's what it means. Now, BPRs. BPR is stands for balanced price range, right? Balanced price range is formed, it forms when two opposite sides of imbalances overlapping in the same price range, meaning a bearish fair value gap overlapping a bullish fair value gap, or vice versa, a bullish fair value gap overlapping a bearish fair value gap in the same price range, right? So BPRs form at extreme levels of a range, or after liquidity is being purged, and when market changes its sentiment, meaning going from bullish order flow to bearish order flow, or bearish order flow to bullish order flow, and it confirms the smart money reversal. So if you're expecting a reversal at a level, what you'll usually see is you'll have a BPR, or you'll have a bounce breaker block. You know, those two PD arrays, BPRs, and breaker blocks, they'll be present. Either or will be present in smart money reversals or manipulations. But how do we use BPRs? BPRs are utilized as a low risk buy or a low risk sell entry models at smart money reversal ranges. Now, the reason it's being called low risk buy or sell is basically because you are buying in the manipulation stage of the market maker model, right? Your stop loss will be much shorter and much smaller than if you were to, enter at a later time. That's why it's called low risk buy / low risk sell. Now, one note here though, not every smart money reversal forms a BPR, right? If it does though, BPR indicates strength in the reversal, and some even call it a sharp return. Because what happens is it comes down. I'll show an example here. So what happens is, in this example, you have a fair value gap, a bullish fair value gap there, right? Then price rallies one more time, collapses, inverts this fair value gap. Now, if you look at on the right hand side, you can see the bearish fair value gap now, which is called CB. Now this area, because it's overlapping, BC is overlapping the CB here, is a BPR, is what we call BPR. Now if you look down here, you'll see that in the black shaded area, it's BPR. Now you can disregard the lower portion of the CB, and now you can disregard this BC itself, and just you can use the BPR level here. This is highly important to note when you're charting, when you're doing your analysis, is basically because this PD array usually gives you the smart money reversal. So let's say this is NASDAQ, right? Let's say we are looking at NASDAQ here. NASDAQ is reversing here, but we don't have an SMT divergence just yet at highs, right? And if you see a BPR on NASDAQ, but when you look at ES and you don't see a BPR there, now you can anticipate ES running the high, running the buy side, whereas Nasdaq trading into BPR, which creates essentially the SMT divergence at high, sets the stage for the smart money reversal. Now you can utilize the BPR to seek short positions, right? That's how you can anticipate. Now, sometimes you don't have this BPR level at reversals, which is totally fine. And the risk is much less here. That's why it's called low risk, in this case, sell. Because you'll enter here, put your stop loss above the high, right? Or here, your risk will be much less if you were to short here, right at the CB low. A couple examples here. So there's a CB here, rather BC here, then a CB. Overlapping area is BP, our balanced price range, right? Price comes up to it, pulls back, right? Then use this level, this zone as a catalyst to go seek sell side, right? That's how you can utilize this area. Now, if it wasn't here though, what you could do is you could basically wait for smart money reversal patterns like SMT divergence and stuff. But usually you'll see this, or price will break below right away and creating a breaker block. It's gonna be either or. On the bullish side, same thing. You're running the sell side, then immediately reverses, right? This is what some traders call sharp turn, sharp return, right? It breaks away from the liquidity level, reverses there, traps shorts here. There'll be short people who are going shorts. Some people will short the CB here, but when it collapses that CB, now you have a BC, right? That overlap zone right there, which I annotated, is your balanced price range, aka your low risk buy entry area. Price will return back to there to balance the marketplace, right? That is a trigger for you to look short entries, or rather long entries, long positions, and it expands later on. And if you look at the swing level here, we have a sell side there, sell side there. From that BPR area to your sell side is essentially a shorter range than if you were to long here, right? Because that'll be your stop loss at the end of the day. Let's say you longed here, your stop loss will be much, much, much larger if you didn't long it there, right? That's why it's called low risk buy. And it's the first stage of the smart money reversal. So the next thing, again, it's about fair value gaps, advanced usage of fair value gaps, is breakaway gaps. Breakaway gaps, first of all, what is a breakaway gap? Breakaway gaps are essentially the untouched fair value gaps. So when market leaves an imbalance completely open, that is what we call a breakaway gap. How can we anticipate a breakaway gap while we're watching the marketplace live, right? It's not an easy task to do. However, it is completely doable. It is completely possible. Now, when it comes to anticipation of breakaway gaps, there are literally two ways to do so. First one, when and if market prints an order block within an expansion leg, the imbalances left behind becomes a breakaway gap. Okay, and I'll show you an example in a minute. And the second way is when and if there is a breaker block present above or below an imbalance, because price has to respect the breaker block. Remember, it has to respect it, and because of that, it leaves the imbalance above or below breaker open, right? Unless there is a BPR present in the marketplace above or below a breaker block. Now, meaning whenever you see BPR, you'll have a breaker block as well. Use the BPR, simply put. Now, breakaway examples. So, this price move so we have a buy side of the curve, then it reverses, energetically moves lower, creating this fair value gap, right? Once that fair value gap is there and confirmed, the following candle is now an up close candle, right? It closed as an up close candle. Essentially, what this is implied order block. Now you can imply this as your order block, and because it shouldn't be violated, this fair value gap above it has to be a breakaway gap, meaning it has to be untouched or stay open. Price shouldn't trade back into there until the drawn liquidity is attacked, right? Your confirmation for this as being an order block is when the moment price breaks away from the order block, this up close candle with like that. Once it low is violated, now this is a confirmed order block. Now you can safely enter a short position, put your stop loss above that order block, right, and target the low. So sometimes you'll see price returning back into the breakaway gap and then breaking lower. That also happens, but that when that happens, what that usually indicates is price is not as strong as I would like it to be. So I wouldn't want to be in short positions when that happens. I would rather have this area stay open. Now the second way, oh, this is a bullish example, sorry. Bullish example, same deal. Price expands higher. In this expansion leg, we have a fair value gap there. Then this down close candle is an order block, right? And below that down close candle, there is a fair value gap, right? That fair value gap, because this is now a confirmed order block, has to be a breakaway gap, meaning price shouldn't trade down into it, right? If you know this information during live, tape readings or live trading, it comes handy because now you know where to put your stop loss. You know what I mean? Like if you know that this has to be stay open, you can put your stop loss above it, basically. And like I said in the bearish example, sometimes it trades into it. It is not likely, but it happens. When that happens, it doesn't necessarily mean you're wrong. It just means weakness, or it just indicates weakness in the price move. In the bullish move, in this case, it means there is a weakness. So as long as it is staying open, it's showing strength in the up move. Like I said, it indicates strength in a move. And the way we use this information, our breakaway gaps, is basically for stop loss purposes or for position management purposes. And breakaway gaps can be used for additional confidence in the strength of the order flow. Just like I mentioned earlier, if I see a breakaway gap being touched, I don't want to be in that position because that means whether I'm right or wrong, that means it's weak, and I don't want to be a participant in a weak market, right? I want to be in a strength, in a strong move. I want to be in and out, right? Now, this completes the first part of the class. And what I want to do is I recently opened a channel in the server. I'll tag it. It's called exercises. Now I would like you to give you a couple of exercise, actually one exercise for you to do, just because I want you to train your eyes, train your mind. Now what I want you to do is I want you to pull up Nasdaq futures chart on the 15-minute time frame. Go back in time to November 9 and November 12th. I marked it here. So you're going to be looking at this price action here. And what I would like you to do is I would like you to annotate all the PD areas you see on the chart that has been covered in this class. Now, what that means is you're going to be annotating fair value gaps, order blocks, breaker blocks, rejection blocks, if there's any, right? If there are BPRs, annotate BPRs. And when you're done with your annotations, I want you to post your drawings and post your charts in exercises channel. And I'll go through them all on individual basis. Now, so the first class is done right now. I can take questions if you have any. I think Sir Nasdaq is asking something. Let me read that. Reused order blocks. Would the two key levels, open and close, and mean threshold, be flipped when price invalidates the order block? Multiple fair, hold on. Multiple fair value gaps. Are there any rules if there is more than two fair value gaps? So that is a great question. Okay, let me go through your first question first. Okay, reused order blocks here. Reused order block. Would the two key levels, open and close, and the mean threshold be flipped when price invalidates? Yes. So what will happen is you can see that here actually. So this is your order block, right? This up close candle is your order block. When the price violates its high, meaning this wick right there, there's a small wick. When it trades above it, it does it here. Now this is a failed order block, right? So it has to violate its high. And on the, bullish side of the things, let me go to that example here. Once it violates this low of the order block, right, which it does with this candle, now this is a failed order block, all right? It can trade into the mean threshold, but that means the order block is still valid. Gotta wait for it completely violating the candle. Multiple fair value gaps, are there any rules? Yes. Beautiful question. I love it. Let me go there. So I need to find an example, but as a general rule of thumb, if let's say you have three fair value gaps here, right, in this leg. Let's say you have another fair value gap above it. What you'll need to do is you got to look at the dealing range when it comes to two or more fair value gaps or three or more fair value gaps, right? What happens is the manipulation will be into EQ of the range or in the discount range, meaning doesn't necessarily mean the highest fair value gap will be used as an accumulation, right? Because it'll be in deep premium in that case, if that makes sense. So whenever you have more than two fair value gaps, just be mindful of the dealing range so that you can anticipate where the manipulation will be into. And usually it'll be into the lowest fair value gap. Are BPRs IFVGs? No, it is not because IFVG is simply here. I can show it here. So there is a SIBI here, right? This is a bearish fair value gap. And when price moves higher, it closes outside that fair value gap, meaning it violates that fair value gap, right? The, the moment it violates it with this candle, closes outside, now this is an inversion fair value gap, IFVG, right? But BPR is, on the other hand, a SIBI, bearish fair value gap, overlapping a BISI. You see the difference there? And they're more significant since both sides of the marketplace, the sell side of the market and the buy side of the market, both delivered inefficiently in that area. Breakaway gaps, where are the stop loss placed? Okay, so breakaway gaps here. Let me see the other example. Okay, here, let's say you are looking for you have a buy side target, right? You're actively looking for a long position. You have this fair value gap, and then you have an order block here, right? And you want to utilize either or. Say you entered long positions in the fair value gap. What you can do, and you should do, is putting your stop loss right at the high of this breakaway gap. Because if you're right, that stop loss above this fair value gap, breakaway gap, should be safe, shouldn't be traded into. Which is beautiful. I love breakaway gaps because whenever I see a breakaway gap, that means I'll be using smaller stop loss, and I love it. You know, that doesn't necessarily mean I'm going, heavier in my position, but you can do that too. I don't recommend it though, especially if you're trading prop firms. Oh shit, it's over. I just got it. Don't worry about it, man. I'm recording this session, so I'll be uploading it. You can watch it on demand whenever you want. Order block doesn't require market structure shift like a breaker block. No, no. Okay, your confirmation of order block is basically the following candle. In this case, you look at this order block, right? This order block is not validated until the following candle, which is this one, violates its high and closes above it. Once it does that, now you have a confirmed order block. Advanced breaker block, how many candles we observe within the wick and then enter. There's no, that's, I mean, I don't count candles and I don't know if it is viable in that case. Let me see. Yeah, I mean, it could. So that level, when it comes to breakers, let me pull it up. So this level could be used as an accumulation area as well. And as far as I'm concerned, there's no way to know how long it'll accumulate in an area. There's no way to know if it spends 5 minutes in this area, 10 minutes in this area. You know what I mean? So I wouldn't count candles there. You would just enter it when it, retests that level, and just let it go. Are the breakaway gap trades best avoided because price can retrace back into them, which are generally big? Hold on, are the breakaway gap trades best avoided because price can retrace back into them, which are generally big? No. So what happens is when it comes to breakaway gaps, let me find it 1 second. Okay. What happens is when it comes to breakaway gaps, the price should not trade into it until the algorithm completes the or attacks the drawn liquidity. Until then, it shouldn't trade back into it. That's why it's so powerful. If it does so before attacking the drawn liquidity, that means you're either wrong with your bias, right? Or sentiment has changed, or whatever the case is, or the move is not strong enough. What time frame are we going to use for the exercise? It's going to be 15 minutes. So you're going to be looking at NASDAQ on 15 minutes. Does your bread and butter setup include breaker blocks and IFED? Not necessarily. It's usually the expansion leg. So in expansion legs, if it's not a reversal, where is it? Here. If it's not a reversal, in this case, it's a continuation, right? Actually, hold on a second. Here. In this case, it's not a reversal, it is a continuation, and it doesn't require a breaker block here. On the other hand, though, in this example, so what happens is the price consolidates here, then rallies here. This is your market structure shift, and now this candle right there, failed order block, is now your breaker block, right? Because it is a smart money reversal or a reversal area. Now there is a breaker block present. So there are literally two ways. If it's a continuation, you don't have to have a breaker block. If it is a reversal, yes, you'll have a breaker block. But if you go on the lower time frame relative to this price action, let's say this is 5 minutes, right? If you go on 1 minute, what you'll see is this manipulation into IFED area, the lower fair value gap. On 1 minute will look like, on 1 minute it'll give you a breaker block, basically, because time is fractal. You'll see the manipulation in that time frame. Forming threshold of an order block. Do you go from wick to wick or body? Wick to wick. So from high to low of the candle. Beautiful. Are there any questions or else I'm probably gonna wrap it out here. Fabio, do you have anything to add or Fabio is I guess MIA right now. I was saying like I guess there are no more questions. I was saying if you have anything to add or ask. Oh good. All right, perfect. Let me see if I missed anything. Okay, beautiful. Like I said, guys, I'm gonna put it in the general chat in a second. I just created an exercises channel. Once you're done with your annotations with this exercise, I want to see it over there. If you have any questions, you can use that channel to ask me questions. I'll go over it all. I'll be looking at your annotations by individual basis, and most importantly, yeah, most importantly, have a beautiful Monday, and I'll talk to you tomorrow. Peace.